Hello and welcome to Car Dealer Live. My name is James Batchelor, and today we are taking a little look back at the year, but more importantly, looking ahead and going to discuss what opportunities there may be for car dealers in 2025. Joining me to discuss all of this is Auto Trader's Ian Plummer. Hello, Ian.
Hi there, James. How are you doing?
Oh, yeah, very well, thank you. Always lovely to have you on. Always love to have you on. Now, before we talk about 2025, let's just look in the rearview mirror. I hate that phrase, but let's just look back at 2024. So, what do you think were the key trends in automotive this year?
3 or 4 key points stand out to me. I think in new cars, we saw a continuation of what started in mid 2023, roughly, which was a return to a let's say, more normal new car market, which was definitely a more push market than the pull market that we'd known when supply was short and demand was high through 21, 22 and into 23. So we saw discounting return, we saw more availability return, lead times have come back to sort of more normal times. So it feels like new cars, retailers face targets, pressures to achieve volumes and so on. So there is definitely a return to more of a push market in new. In used, we've seen very good levels of continuing demand for used vehicles, good levels of continuing sales growth, up around 5% again in used cars. So that's been positive. I think we've been also happy to see a return to data-led decision-making on pricing after the start of the year, back end of 23, when trade declines led to some retail value declines that we frankly thought weren't justified on the back of a continuing level of strong retail consumer interest in buying cars. And I guess on top of all of this and across both new and used cars, you've seen a continuing transition to electric vehicles. It's not been without its challenges, without doubt. That's creating additional push in that new car market. Those vehicles are flowing through into the used arena, actually selling extremely well. The 3 to 5 year old used EV segment is the fastest turning on our site. So the transition to EV is definitely happening, and it's definitely flowing through into used cars. It's affecting more and more retailer forecourts and so on as things progress in time. And we've actually now, according to our data, gone past peak petrol, which is maybe a headline point for people to sort of have in mind. There won't be as many petrols in your park going forward as there have been. So that will change the kind of makeup of forecourts going forward. All of that, just to sum up in one word, I think we've got increased competition that highlights for me a big theme of 2024 and into 25. Increased competition could be both from a brand perspective, as OEMs, there are more of them. There's increased competition for that sort of push market, but increased competition for used vehicles. Sourcing's more of a challenge, so competing to find them. And as retailers in the franchise world have to go into older vehicles and all makes vehicles, they're coming up against the independent customers who are obviously very good in those sectors of older cars too. So they're competing for the same customers and similar stock. So those are probably 4 key highlights for me: push in new, strong demand in used, transition to EV happening, and increased competition.
Let's just drill down just a little bit more in terms of the push market, because I mean we really have seen that this year, haven't we? And that flux between demand and supply actually tilt quite considerably, didn't it? So I mean, how do you think the market performed in terms of demand and supply?
Well, I think the new car market has definitely been challenging in the last few months. So we've seen a market that's been bolstered, frankly, by the fleet channels. After those fleet channels were almost sacrificed in 2021, 22, when there wasn't enough supply, clearly then OEMs put their available supply due to those semiconductor shortages I'm sure still recall, they put that into the retail channel simply because those are the sales that will give them the best level of profitability, the lowest level of discount. So after the retail channel had been sort of satisfied in inverted commas, there was no continuing pent-up demand there. The flow through happened into the fleet channels where there was pent-up demand. So fleet has sustained the market, but what you've got now is an imbalance, if you like, through 2024 of retail sales only accounting for around 38% of the market. Ordinarily, over historic times, they'd be more like 45%. Through 21 and 22, they were more than 50%. So that has meant that the OEMs have had to push progressively into leasing channels, into Motability, doing Motability more like 20% of the market. Historically used to be more like 10, into rental channels and so on. Rental customers had 4-year-old vehicles on their fleets at some periods of time. They historically have 6-month-old vehicles, so they needed to replenish their stock. But as that's happened, discounting has increased through the retail channels. Discounts for EVs have been up at 12.5% recently. Back in early 23, they would have been at 2 or 3%, and they would have been lower than ICE. Now they're higher than ICE. So all of these factors play out in the marketing approach for manufacturers needing to stimulate activity, needing to conquest outside of their existing brands, and needing to generate additional inquiries in an ever more competitive market. There are more brands out there with more models and a more confused customer who's thinking about ICE and electric and all these new different players that they've got to consider. So there's a real, really tight and hot competitive market in new cars that is likely to continue apace, I think, in 2025.
Yeah. And how about used?
So used cars, a lot stronger. The problem in used cars for a retailer is more often around sourcing effectively, because supply is still below prior year and demand is high. So if you're able to source vehicles effectively, and the 3 to 5-year-old segment is the one that's the lowest in terms of available cars, simply because if you map back in your mind 3 to 5 years ago, what was happening? Well, we sold roughly 3 million fewer new cars because we did 1.6 million new cars in 2020, 21 and 22 compared to a long-term average 2.5 million or so. So those 3 million fewer cars are now in that sort of 3 to 5-year-old market. So there's fewer of them. And you need to source very effectively. Retailers are often going to older cars, so reconditioning is a challenge. So sourcing is probably a bigger issue for most retailers than ever has been. But actually, demand levels, as I said, have been very good. We've seen 8% year-on-year increases in average monthly site visits, 83 million visits to our platform on average each month of this year. So the general interest in car buying, new and used, has been strong. And the overall sales volumes through the year have been 5% up on prior year. So there's been healthy flow through of interest into sale, and potentially an opportunity for retailers to look at turning their cars slightly slower and retaining slightly more margin, because when demand is good and supply is tight, what you've got at the moment is speed of sale being extremely fast, which is very healthy from a financial point of view, but it's 3 days quicker than it was last year, 3 days quicker than it was pre-pandemic. And to a degree, for some cars, we'll come to that in maybe more detail in a moment, that's slightly too quick.
Yeah. Let's just talk about the ZEV mandate just quickly. I mean, how do you think the new car market responded to these, well, let's face it, pretty tough 22% target this year? How do you think it responded?
Well, it's responded by having to push, basically, as we've touched on, pushing through discounting in the retail channel, pushing through self-registrations to some degree, although there are not an excessive amount of, I should say, electric within the overall mix of self-registration that we can see flowing through onto our site. And the number of self-registrations or any form of tactical activity is still lower than it would have been pre-pandemic, by around 30-odd%. So there's a heating up market. But they've responded in particular by pushing through the fleet channels where, as we all know, there is a fiscal benefit for various people, whether you're buying with a benefit in kind advantage or whether you're using salary sacrifice and so on. Equally, the Motability channel has definitely risen to the challenge of pushing the electric opportunity to more consumers. So those channels account for the vast majority of electric sales. And in retail, electric is only over the course of this year accounting for around 1 in 10 retail sales. So there's a big challenge there to actually get more retail buyers to go electric. Although we should bear in mind that a lot of people using salary sacrifice, even going through a leasing channel, benefiting from that BIK benefit, excuse my poor choice of words, or using salary sacrifice, they're actually private individuals who benefit from a sort of an umbrella fleet channel offering, and they engage on Auto Trader and any other platforms in a similar way to a retail customer. But actual retail customers is where it's going to be at next year. And clearly at the moment, there are a large proportion of brands who aren't at their ZEV targets and are going to need to push even harder next year with a higher percentage number, but for many, a catchback to do as well.
Yeah. Well, let's talk about next year then. So, I mean, what are your expectations in terms of next year? And I'm particularly interested in terms of demand, the push more to electric, and also we've got some new brands potentially going to be arriving in the UK as well, haven't we?
We have. There's a lot in those questions. So, in terms of expectations for next year, I could break it down into maybe new cars first of all, and used cars. Then we'll
Yeah.
come to maybe brands and EVs and so on. So, new car market for next year, we expect to be slightly positive on this year. Still just below 2 million cars. So that's a reasonable market. We don't want excess push. I don't think any of us, whether you're an OEM or a retailer, that flows through into impacting used cars and negatively. If you've got too much push, then you usually have too much late plate activity, whether it be fleet channels or self-registration and so on, and that pollutes the used car market. But 2 million does create still a shortage of used cars to a degree for many actors in the market. That 2 million will hopefully be a little bit more rebalanced towards slightly higher retail share. I do think that manufacturers will need to rebalance now and push a bit back into retail, having filled out their channels of fleet mix and so on in the last year or so. Used cars, I think, will equally grow slightly, with expecting 1% or so of growth in the used car market, up to about 7.6 million cars. So again, still there behind where it would have been by about 3% or so in 2019, but a very healthy overall market with, like I said, cars turning quickly and hopefully continuing to generate the kind of positive value and margins we're seeing for retailers, and a good proposition for consumers. Because I should add, one of the challenges we do see in the market, when you see that the retail new market is quite tight now and roughly flat over the course of the last year or so, but that the used retail market is very good and the used is 4 times bigger than the new, is something must be going on. And our proposition is probably based on the fact that, just to analyze that the new car market has seen price growth to a degree that many buyers have been priced out of new cars. And if manufacturers and retailers want to get more people back into new cars, there will need to be, I think, a price walk, for example, in terms of renewals on a PCP that is more appetizing and more likely to lead to a new to new journey rather than even a new to used journey. So hopefully we will see some rebalancing there. Declining interest rates, which we're all looking forward to hopefully seeing, but they haven't really materialized yet, can hopefully also play their part in enabling all of that.
Right, let's just talk a little bit about new brands that are going to be arriving. I mean, ultimately, there's going to be more competition, isn't there? I know that's quite a simple way of putting it, but I think that's quite true, though, isn't it?
There is definitely going to be more competition. I mean, put simplistically, if you take 2019 and compare it to where we'll be in 2025, in 2019, the new car market was 2.3 million. The retail part of that was a bit more than a million. And there were 45 or so brands in the UK. So quite a healthy size of market for a reasonable number of brands, of course. But that looks rather different when you compare to 2025, where there will be fewer cars, as I said, just south of 2 million cars, probably more like 750,000, 800,000 retail. So quite a lot less retail to go at. But more brands, probably more like 62 or so, we expect to be in the market in 2025, potentially even more. There are many more new entrants we've been speaking to in recent times who are about to confirm details about their launch dates. So more brands for a smaller market clearly means more competition. So there's a pie out there that is going to get slightly smaller, but more people are looking to take a slice of that pie. So by definition, there's going to be quite a few who are going to be looking at a smaller slice. That means more competition. It could well mean more push. That could well mean more incentives in the market, more consumers being brought into new cars, and more activity that potentially, who knows, may even grow that 2 million number. We do need to see that activity because it's that very same competition which hopefully will drive electric prices in the right direction for the consumer, will encourage, challenge, force, if you like, almost the manufacturers into doing whatever they need to do production-wise to reduce their cost of building those cars so that they can reduce the cost of selling them, get more people to buy them. As we know, the ZEV number is a big driver of the new car market. We're expecting SMMT numbers as well, expecting to see more like 22 or so % of actual sales next year of zero emissions vehicles. We're at that number last month, more than that even, but over the full year, we're still about 18.5%. So we are going to see it grow. But if it doesn't grow, as we know, brands may be tempted to throttle back their ICE number. We don't want that to happen. So the most important thing is that brands need to be able to unlock their zero emissions vehicle sort of potential by hopefully using that competitive stimulus in the best possible way, satisfying consumer interest, which is, as we still see, very high for electric on our platform.
Okay, right. Well, very interesting. So, my final question, Ian. I mean, what do you think the opportunities are for retailers next year? And importantly, I mean, how are you going to support them?
As always, there's lots to focus on and lots that we're looking to do to support our retailer partners in all the various areas that they're working in. I'd highlight three key points. The first would be an optimization and acceleration through data and data-led decision-making wherever possible. We've touched on that already today, but data-led decision-making around pricing, for example, is crucial. We can see that there are profit opportunities still being left on the table by some retailers who've got high retail rated cars. We know what that means. They're good stock items and so on that are being sold at less than 95% of the retail value or less than 98% of the value. There are actually 13% of cars on our platform in those categories right now. That's around £3,000 of value that are being left by every single retailer on the table right now today, and by definition probably every other day going forward. So looking at optimizing data, making sure that you use data equally to source your vehicles as effectively as possible. We've touched on how much sourcing is going to be a continuing battleground of the future, using trended valuations, for example. Today, right now, you're looking to build up your stock to start the year on the front foot. Use those tools as effectively as you possibly can to optimize and accelerate. The second theme would be around digital excellence, digital merchandising, and so on. We've talked about that a lot. As we've touched on already, it's a very competitive market, whether that be on used vehicles with everybody kind of competing for the same stock, or new vehicles. But I think that the key challenge there, if you take the example of new cars, is how we can help also at Auto Trader to stimulate interest in new cars. Now, we've done, I think, a bit of a job on that, and more to do in the last few months as we've been advertising, stimulating interest in new cars, partnering with What Car, driving more interest into your adverts when you've got your new cars on our site and so on. As you've got more availability and more affordability of new cars, as the market is more attractive to consumers today, we've got 30,000 new cars and vans on our platform. Visits are up 20% at the moment, year on year. So there's more interest there. And the key is that you turn the heads with your digital excellence of the consumers that are there into your stock. The brands who advertise direct or an agency, or the retailers advertising their new stock, are all able to get around 20% sales influence of their new cars at least a brand level through their quality of work. The top performers get north of 30% and even more than that. So there's definitely an opportunity in that highly competitive, conquest-focused new car market. The same would always apply, obviously, in used cars, to stand out from the crowd if you are in the digital excellence sort of cohort of retailers. The third point would be around simplification and focusing on the essentials. We think we can help with that with AI solutions. We know retailers are using AI solutions in parts of their sales or after sales businesses as well. But with solutions like Co-Driver, we'd like to think we can help you to focus on the essentials, to focus on what you do best, which is looking after customers, dealing with inquiries, giving the advice and support that consumers really enjoy and need from retailers. But hopefully by enabling you to do that, we're talking about fundamentally simplifying the other stuff that gets in the way, populating adverts, choosing the order in which to put your imagery and so on each of your adverts on our platform. So the same would apply to the other data solutions we have within our IT Connect suite, where you can better connect your systems with ours and enable time savings that can focus you back on the essentials. And if you can do that, fundamentally, the biggest point of all of this would be the ability to focus on retail excellence, consumer service, and delivering, like I said already, exactly what consumers want, which is your advice, your support, your excellence in retailing. So I'd encourage you to do all you can to engage with the tools that we've put at your disposition, and we will do all we can to support you in hopefully having a fantastic 2025.
Yeah. Brilliant. Perfect way to end, Ian. Thank you so much for all of your analysis this year, and look forward to plenty more interesting conversations next year. But for today, thank you very much for joining us.
Great. Thank you, James.
Well, that's it for today's Car Dealer Live. Join us again very soon. Bye-bye.